Hello, everyone. I'm Barry Corcoran, along with Lawson Corcoran, and this is Financially Speaking.
Hey Barry, thanks for sitting down today. I think this is going to be a great discussion about where we've been so far in 2024. Now that we are approaching the end of the year, kind of look at what 2025 might look like, kind of review some of the volatility we've seen in the market recently, and just kind of remind everybody what we're going to do with our planning. So just to provide some context, let's go back to the first of the year when we were coming into 2024, rates had been high for a while. Interest rates had been high for a while, and people were expecting a recession this year. There was a lot of people concerned that the economy would slow down. People were actually expecting the Fed to cut rates up to six times. People were expecting that to happen. But throughout most of the spring and summer, we kept seeing strong economic data. It showed that U.S. economy has been very resilient so far. We've seen the stock market time and time again notch new highs. Most of the spring, people were holding their breath, kind of waiting for a big drop in the market, and it really just never came, other than that one week in June. But that being said, we kind of got to September when the Fed met. We kind of got there, and the Fed had finally seen some economic data that supported them cutting rates, which people were looking forward to. And so I think everyone was thinking, man, we finally got to a place where we're going to have a soft landing. We may not be in a recession. Rates are finally going to come down. The economy's still resilient. People have been concerned about inflation, and so people are just kind of looking for a resolution. So I'm going to share my screen real fast and just show a couple more charts before I let you go. But uh, as we see back in September when the Fed cut rates, the market enjoyed those rate cuts. We saw some new highs in the market, but we also saw, if I can pull this up, 10-year Treasury yields have risen. It really just reinforces the point that market's growing hot. People are taking that money they had in treasuries, pulling out, putting that in the stock market. And they want to be a part of that growth that we're experiencing. So I think those 2 points about the bond market, or at least 10-year treasuries and in the stock market, uh, reacting to those rate cuts, along with inflation data that actually ticked up in October. We saw a little bit more inflation in October. Um, just kind of is begging the question, did the Fed cut rates too early? So, can you kind of speak to what the Fed has done by cutting rates so far? Have they done that too early? Are we good to go, or will rates ever get back down to where they were? Kind of talk to us what we're gonna see here in the next few months and into 2025.
For our clients, I'm not sure that they're entertaining this controversy about whether the Fed raised or lowered interest rates too fast or and too much. In the financial circles, we think about it all the time, and I listen to the commentary all the time about that point. And that's probably the backbone of how we see the economy and the financial markets, excuse me, over the next 12 months is that question. And I think this poses a very good uh, uh, point that I want to make is that, yes, at the beginning of the year, the majority of economists who are well paid by very large institutions to make predictions predicted a recession in 2024. And they, as you said, expected a recession so severe that the Fed would lower interest rates six times. Um, and that didn't materialize. The economy was growing, and inflation began to decline through those months. And when the Fed thought it was time to do so, it reduced interest rates by 50 basis points. So we had a real positive market in response to that. So it's been a very good year for the stock market. It's been a very good year for the economy, and everything seems to be going very well. So now this current commentary is did the Fed reduce rates too much and too quickly? Is more of those same people at the beginning of the year predicting is about interest rates. And so for us, we just kind of discount that rhetoric and stick to the facts. And what we see is continuation of the growth of the economy. Do we expect it to slow somewhat next year? Yeah, it just cannot go at the pace that it's been going this year, and the same for the stock market. So is it negative next year? Don't expect that. We expect it to be positive, but not as good as this year. This was a very good year.
Yeah, absolutely. I think it shocked a lot of people in a good way. What we've also seen since September is some volatility in the markets because of the presidential election. Obviously, that's over with now. Everyone's kind of settled down. We saw, a big swing in the market post election, and things kind of settled down a little bit. What are we going to see as far as volatility in the next few months? Should people be concerned about volatility in the markets between now and the confirmation of the president and president-elect in January? Should they be concerned? Kind of talk to people about that a little bit.
Well, uh, concerned. I don't know that I would be concerned. Expecting uncertainty is where we should be. Always the market is uncomfortable with uncertainty, and always when it gets towards closer to an election, there's more volatility in the market because we're just uncertain. And once one party or the other prevails, then there's more clarity about that. And so that uncertainty evaporates. The stock market figures its way out and navigates its way forward. Now we're in a period of lots of discussion about all kinds of changes about how this new administration is going to how it's going to govern, and to be concerned about that is different from uncertainty. And so are the financial markets reacting to some uncertainty about these decisions and confirmations in the Senate and how things are going to unfold in Washington? I don't really think that the financial markets are reacting to that. What they're reacting to is the Federal Reserve lowering interest rates more, so that the economy, the cost of corporations borrowing money is lower. They're more profitable. When they're more profitable, the stock market goes up. So to the extent that there's uncertainty, yes, the stock market struggles with that too. But somehow the other, always, it finds a way to navigate through changes, whatever changes that we see coming out of Washington D.C. And it's probably more difficult for businesses to navigate the changes of what consumers want to buy. Whether the food that they buy or the clothes that they buy that have changing attitudes and changing pocketbooks, and those are the things that corporations are far more concerned about than changes that go on in Washington. And I'm not trying to discount that there's emotional social changes that are being discussed, but that's a democracy. But that doesn't have anything to do with your portfolio. Doesn't have anything to do with the stock market. It doesn't change anything that we do for you.
Yeah, absolutely. Again, it doesn't change the way that we invest necessarily. Doesn't change the way that we plan for retirement. I think something that may impact that is more tax legislation or regulations surrounding investments. I think we've heard some talk about cryptocurrency. We've heard some talk about, again, new tax legislation, new regulations with the IRS, all sorts of things like that come with new administrations. Talk just a little bit about that, what we are kind of anticipating in 2025. I think there's a lot of speculation out there. Can you kind of talk to us about what that might look like this next year?
Yeah, well, there was a huge tax law that was passed in 2017 that lowered interest rates, and we've been enjoying that for many years. And it's scheduled to expire at the end of 2025. Now the expectation is that most of those, if not all of those, uh, uh, tax changes are going to stay in place, and so that means that our uh, tax planning strategies are not going to be disrupted. And so I think that's a positive. Yes, there's going to be evolving tax changes, and in general, when you lower taxes, there seems to be more economic activity. The flip side of that is how can you lower taxes and reduce the federal deficit and resolve the amount of interest that the government is going to is paying. And so I think that's going to be a real challenge for the next few years is how do we navigate that balance between optimal taxation and debt reduction. And just like the government, just like you and I, when we borrow too much money, it's painful paying it back and paying the interest. And so just doing things, making changes gradually can get us in the right direction. And that's what our hope is that we see some gradual changes to stabilize that.
Yeah, absolutely. And I think that's another thing to think about as far as big changes in legislation. It's really rare to see regulations and legislation be passed like that. It's
Right.
uh, and for it to be a big swing, and that these things are
Yeah.
going to happen more gradually than people think. And so,
Yeah.
yes, you have to be agile as a business owner, as an investor, when new changes come into place. But we have time to do some planning, and I think that's where we can help clients, and where we have helped clients in the past is with tax software, tax planning, looking at these new rules and changes to see how we can optimize for them.
Yeah. And for sure, the rest of this year, over the next several weeks, we'll be looking at every client's portfolio just to see where there's opportunity to harvest tax losses and
Yeah.
see if we can help them reduce their tax bill. And so although that's an ongoing process, for us, then it's our focus for the closing weeks
Mm,
of this year.
absolutely. And kind of a last point I wanted to discuss with you that we've seen a lot, this past year, and we still see today is geopolitical risk. It's recently, as of this week, actually, there's been some heightened tensions in the Ukraine Russian war. We see a lot of unresolved conflict in the Middle East. Um, there's been a lot of speculation about tariffs from the new administration. Um, Kind of talk to us about what geopolitical risk means for us as investors. Does it have any impact whatsoever? I think a lot of people are concerned about it, concerned that, is the United States going to get dragged in? What does that mean for the economy? Kind of talk to us about that a little bit.
Well, my concern is that when you watch TV and you listen to the wrong channels and the talking heads, and they get everybody riled up about, oh, this could happen, that could lead to this, that could lead to that, and then the next thing you know, we have this war or this development that's going on, and I just historically that just actually doesn't have an impact on your investment. Yes, does it impact short term? Some events do. I'm really surprised that we haven't seen more reaction just with what's going on in Ukraine over the last couple of years, and what's going on in the Middle East. It's almost like the financial markets have gotten accustomed to disruptive events because they just don't react the same way that they did. Huge events like the assassination of John Kennedy and the first Arab-Israeli war and different conflicts that arise. And we can go back through history and just see one after the other of these geopolitical events. And some of them have a real strong reaction in the financial markets, but then others just really have a mild response from the financial market. So once again, I choose to discount the rhetoric that I'm seeing on these from some of these newscasters and speculators about what's going on. If there was a um, if there was a big concern, would absolutely take action. But you can see on this chart that in response to different events, geopolitical events in the past, what does it mean? A few months or a year after the event, and everything seems to kind of stabilize. I think what happens in the financial markets is that there's a point in a crisis where the uncertainty is resolved or is that the direction of this conflict or geopolitical event has more clarity than the stock markets react to that. Just like any other surprise or unexpected event that happens in the market. So I just hope that we don't spend too much emotional time getting tied up into the speculation and the rhetoric. There's always been conflict. There will always be conflict. And I think we're unfortunately just getting a lot more acclimated to it, at least from the standpoint of the financial markets.
Yeah. And I think that you're exactly right. That's just the day and age that we live in. There's a lot of information out there, and people respond quickly to that information. Uh, and so another thing we have to remember is when the market fluctuates, day by day, week by week, a lot of that isn't from investors like you and I. It's from big hedge funds and big investment firms that are doing a lot of trading that are real, moving a lot of money around. And so when people see swings in the market, it's not necessarily Jane Doe down the block that's responsible
Right.
for all that volatility. So
Yeah.
I agree
Well,
with you
yeah.
for sure. Yeah.
Yeah, our decision about which mutual fund to put in your portfolio doesn't move the market for sure. So,
Exactly. Yeah.
yeah,
And you're
so
exactly
yeah,
right
so,
on the rhetoric and the conflict. There's always going to be anxiety, and there's always going to be something on the news, whether it's geopolitical conflict, whether it's the new administration and rhetoric surrounding that, whether it's speculation on the markets and rates and where the economy is heading. There's always going to be anxiety there. There's always going to be people that are selling that because that's what sells news. But yes, at the end of the day, it's all about staying invested and sticking to the plan. I think one last chart I'm going to show here that I think is really good at highlighting this is staying invested. This shows if you missed the best days in the market over the past 25 years after investing only $1,000, as you can see, the more days that you miss, the less less money you would have made over the last 25 years. So it's not about timing the market; it's about staying in the market. They say
yeah,
time in the market beats time in the market. So
yeah.
uh,
Well, I love that chart, and it's the real information for investors to understand that timing the market is impossible, and so timing the market from a geopolitical event or decisions being made in Washington D.C. is just it's just simply impossible. And so sticking to our investment strategy that's diversified, that's based on your risk tolerance, that's the best strategy. And when you get nervous or concerned, call us. We'll talk to you about your investment strategy and what's going on, and get you through that moment of concern that you may have. We feel very confident in how we do things because we've been doing it a long time through lots of elections and through lots of geopolitical events. And we feel pretty confident about how we see the economy and the investment returns in the coming year over at least through the middle of next year, and expect the Federal Reserve to monitor inflation. And as that goes down, I think we'll see positive things develop in the market. Your thoughts, Lawson, about next year?
Yeah, I couldn't have said it better. I think obviously no one has a crystal ball. We don't know what things are going to look like. Obviously, there's a lot of my point in bringing up, coming into 2024, people were dead wrong, and we're going to be dead wrong probably every year for the rest of our lives. That's just how things work, and so we can't react quickly to a bunch of short-term volatility. It's not worth it because if we try to time the market, things are going to go poorly. So again, next year is going to take care of itself. Big changes like tax legislation, big changes that come down the pipe from new administration. We're going to be able to react. As advisors, that's our job. We stay up to date on new information like that, and that's what impacts a plan is big changes like that. But none of that's going to happen in January or February. That's going to be down the line, and so I think this is good to help calm a lot of people down, especially going into the holidays. People can kind of relax and say, "Hey, there's a lot going on right now in the world, but we're going to be fine because at the end of the day, we're sticking to the plan. Nothing changes." And yeah, I think that's great for people to hear right now. So, any last thoughts?
Well, we just wish everybody a happy Thanksgiving and hope that you'll focus on joy and family as we close out this year and just try to not focus on speculation and rhetoric and stick to the facts. And we just wish you all a great holiday season. I'm Barry Corcoran, along with Lawson Corcoran. This is Financially Speaking, and it's November the 20th, 2024. Have a great day.